Strong Wholesale Funding Regulations by www.theforexnittygritty.com. The new U.S. Federal Reserve Chairman, Janet Yellen, spoke recently about strong wholesale funding rules. As reported in the online Fox News, Yellen focused on liquidity issues in banks, a problem that has been partially addressed by raising international standards for the amount of capital banks need to keep in reserves. The need for strong wholesale funding regulations goes back to the near collapse of financial markets in 2008, when large banks did not have sufficient cash and borrowers could not get help in short-term credit markets. The Fed believes that strong wholesale funding regulations are needed on top of the so-called Basel rules, which raised capital reserve requirements for major banks. For those of us who are not international bankers, however, just what is wholesale funding? Wholesale funding. Banks rely on wholesale funding for capital when deposits are low, such as when interest rates are very low or when the economy is weak. Wholesale funding is the use of other resources of capital outside of core deposits used by bank to manage operations and limit risk. Sources of wholesale funding include monies from local, state, and federal sources, advances from the U.S. Federal Home Loan Bank, the primary credit program of the United States Federal Reserve, foreign source deposits, deposits from internet or CD listing services, and brokered deposits. A major issue with wholesale funding is that it is typically very interest rate sensitive. Sources of wholesale funding, such as wealthy foreign investors, commonly chase high interest rates and can easily pull a large chunk of a bank's wholesale funding overnight. Whatever the reason, when wholesale funding drops off, a bank will not have enough working capital to do business. This is what happened to many large banks during the recent financial crisis. This is why Fed Chairman Yellen is talking about stronger wholesale funding regulations. Basically, when banks are less leveraged, they are more secure. However, the Fed has been fighting a battle to ensure liquid capital markets since the 2008 market crash and before, and is not going to tighten up credit markets as to cause another credit crunch. Is any of this working? Deutsche Bank details its funding and wholesale funding sources in its Investor Relations Funding online page. Diversification of our funding profile in terms of investor types, regions, products, and instruments is an important element of our liquidity risk management framework. Our most stable funding sources are capital markets and equity, retail, and transaction banking clients. Other customer deposits and borrowing from wholesale clients are additional sources of funding. Unsecured wholesale funding represents unsecured wholesale liabilities sourced primarily by our global liquidity management business. Given the relatively short-term nature of these liabilities, they are primarily used to fund cash and liquid trading assets. Unsecured wholesale funding comprises a range of unsecured products, for example, certificates of deposit, CDs, commercial paper, CP, as well as term, call, and overnight deposits across tenors, primarily up to 1 year. In addition, included within financing vehicles is 11 billion euros of asset-backed commercial paper, ABCP, issued through conduits. The bank goes on to show through a number of graphs where its wholesale funding comes from. Is the Fed doing enough or too much? From the viewpoint of a forex trader, stable financial markets are good for hedging risk in international transactions. Volatile markets can lead to trading profits if the speculator can successfully anticipate which currency will win and which will lose during a financial meltdown. Stronger whole funding regulations are part of the picture of what the Fed is doing. And the stimulus program in which the Fed purchased U.S. Treasuries and other bonds is another. The Fed is tapering its stimulus program and is generally expected to close out monthly purchases by year-end. Interest rates are at issue here, and their effect on the economy, national and global. The current online issue of Forbes speculates on when interest rates will rise and a change in Federal Open Market Committee interest rate targets. The FOMC participants raised their short-term interest rate projections from 0.75% by the end of 2015 to 1%. Though the increase wasn't very large, it was a move the markets did not embrace, judging by the ensuing sell-off in equities. The 2016 forecast jumped from 1.75% to 2.25%. This also seems to indicate a change in the FOMC's thinking. A concern for Forex traders is how well the Fed under Yellen can handle all that is on its plate. And a bigger concern is how the market reads the actions of the Fed and will over-adjust, driving currency prices too high or too low. For more useful information and insights into currency trading, visit www.theforexnittygritty.com.